This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
Now let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at macrovoices.com. Just go to our homepage, macrovoices.com, and click on the red button over Diego's picture saying, looking for the downloads. Now, Eric, let's just start off with crude oil and the EIA inventory.
EIA printed a build of 1.4 million barrels of crude oil, but hold on, the crude oil build was the only build on the board. Cushing, Oklahoma drawing down 1.6 million barrels. Fears are growing of tank bottoms, and despite the higher flat price, we're starting to see the term structure, meaning the backwardation, pick up again. The big drawdowns were in finished products. Gasoline drawing down 2.9 million barrels, and distillates drawing down another 1.7 million barrels. That's a net petroleum drawdown of 3.2 million barrels. Again, a drawdown, despite the fact that the headline crude print was a build. U.S. production ticked back down to 13.3 million barrels. That's the plateau level that we've been holding for several months. Let's see if we can get a trend going above that level. We saw a big 10% move off of that recent bottom, which was right around the 200-day moving average at 71.76 on WTI. We saw a fresh 6-month low this week on Cushing inventory, and that's no joke. Remember, we need to have that operating volume of at least 25 million barrels or so of physical crude oil in Cushing, Oklahoma, in order to be able to blend different grades together and so forth in order to supply the country with the oil that it needs. So it's no joke that we're getting to fears now of getting below that operational minimal level. There's plenty of good arguments to be made for why perhaps there's a new structural bull market in play, and plenty of reason to also fear geopolitical escalations, which could take that bull market even higher. Just take a look at Wednesday's tape action, selling off hard despite the net petroleum build, the 6-month low on Cushing inventories, and the looming risk of a major escalation in both the Ukraine and Israel-Iran war theaters. Hot inflation print could potentially also add to the bull case, at least in the long term. But it's hard to chase this move now. I missed the 71 handle bottom, so I'm not rushing back in on the long side of this trade to chase it. If we get another test back down in the low 70s, well, maybe I'll start to think about a strategic long at that point. But given the uncertainty and the risk of a significant recession, it's really hard to justify putting much leverage on in either direction here.
Yeah, Eric, I wanted to just show on page 2 that chart of crude oil. And really, I tried to zoom out and capture a couple of years in here, because what I wanted to really highlight is that oil really has been in almost an 18-month trade range, more or less capped between $70 up to $90. And we find ourselves basically trading right in the dead center of that 18-month range. Oil is lacking conviction to the downside or the upside. And I think that this trade range will continue to prevail on the short term. Clearly, there's a catalyst that if there was some sort of escalation in the Middle East, that there could be a right tail move, but that can't be assumed to be the most probable outcome. It's simply a risk that could bring oil very quickly to the top end of this range. There's not much to say about this other than let's see whether or not it can make it to the highs of the summer. Now, let's get Nick involved in this conversation and talk about the equity markets here. Now, Nick, the S&P 500 continues to bounce after that carnage. What are the levels you're looking at S&P, and what are your thoughts?
Yeah, Patrick. So right now, spot price on SPX is approximately $54.90. And we have an implied move for the September 20th monthly OPEX of plus minus 200 points. Therefore, we have an upper implied move of 56.90 right near all-time highs, and a lower implied move of 52.90. Right now, we have key resistance at 5,500 and key support at 5,300. I'm inclined to think, given that we've seen soft PPI, inline CPI, and better than expected retail data, that we've seen upward move toward that 55.50 area perhaps before retesting a lower area of around 5,300 or so.
Absolutely. The catalyst for the sell-off was this big yen carry trade unwind, and really that seems to have completely stabilized. And in order for the sell-off to continue, there would have to be some new catalyst of negative news to come in, and it simply did not come from either retail sales or the inflation numbers. And so now the market has pretty much unwound almost all of the selling back above 5,500, where above the levels where there could be downside gamma from dealer positioning going into this week's option expiration. And so everything is settling down in here. The way I kind of look at this is that if the markets here don't sell off now, which they didn't, then we're in a likely crawl back towards a double top retest. I still think that there's a very reasonable probability that the highs that were put in July will be the highs of the year. But often the markets will do multiple tests of previous highs in a bigger topping formation. And at this stage, the last sell cycle is over. So the question now is that does the market go for a full double top retest of its previous highs? And it is on the table. I'm not super bullish, but the path of least resistance for the remainder of the summer could be that kind of a crawl higher. Moving on, though, to page 4 here, Nick, we have the Russell. And what we obviously had was a big jump in the Russell back in July, and they gave it all back. And what's interesting is that in spite of the big bounce in the S&P, the Russell is just right back into that trade range that it's been in all year before that breakout. What's your thoughts here?
Yeah, Patrick. So I am still bullish on the Russell up to that all-time high area of 2,400 or so. I do think we see outperformance for the remainder of the year into the election cycle as well. And I am staying along via butterfly call spreads here.
All right, Nick, I wanted to move on to page 5 to the Nikkei. This is where the crash happened. There was a 25+% drop in the Nikkei in less than a month. And we've now 50% retraced that sell-off. So it was like a bungee cord tied to the feet of it. It jumped off the bridge. The bungee cord extended and now slingshotted it back the other way. I think that at this moment, watching what the Nikkei does back in this 37,000, 38,000 area will be very interesting, because if the Nikkei in any way starts heading back down to retest 35 or 34,000 to establish a bottoming formation, I think that the market will kind of pay attention to it. I don't know whether the U.S. equity market is going to be as sensitive to just short-term movement in the Nikkei as it was to the shock that came from the yen carry trade unwind. But the Nikkei, I think, on the short term is going to start hitting some overhead resistance. Finally, though, I want to just get the conversation started about the Nasdaq. We have on page 6 the QQQs. First of all, let's start off just with the levels you're watching here, bud.
So spot price right now in Qs is approximately 465. Right now we have an implied move for the September monthly OPEX of plus minus 23 points. Therefore, the upper implied move is 488 and the lower implied move is 442. Right now we have key resistance at 480 or so, and we have key support at 450. I think we see perhaps some buying into the earnings call for NVIDIA, which is in a couple of weeks. And after that, it's anyone's guess. But I do think that the all-time highs at 504 area or so should set a top for the remainder of the year or so.
I agree with that. And what's interesting is that even though the Nasdaq has bounced in line with everything else, the S&P bounce seems to be on a relative basis more distinct and pronounced. And that's the interesting part, is both the Russell and the Nasdaq seem to now be lagging, and the S&P 500 is where that flow is. And so let's see if that trend continues. All right, Nick, moving on to that page 7, that volatility index, what a spike that was. We only see these types of moves in market crashes, and yet the S&P was barely off 10% off of its highs for this type of a spike into the 60s. But look how fast we mean reverted right back down. And when we're back into the teens, we're at the 16 handle right now. And obviously with a S&P 500 that's bullishly tilted in the post-retail sales number, we're finding ourselves coming right back into those trade ranges where we've been numerous times throughout the year. How do you size up the vol market here?
So right now with the VIX at about 16 handle, we can expect to see top to bottom intraday ranges on SPX of about 1% or so. And as I said in the past, buying insurance when it's cheap is pretty prudent, especially if you're holding a portfolio that correlates heavily to the S&P. And I think this is where a lot of, fund managers can learn from their mistakes perhaps and insure your portfolios when it gets cheaper again. That being when the VIX goes below 15 or so, and insurance for half a year or so out gets very, very cheap, especially when you have some nice upside in your portfolio. It's not a bad idea to buy some insurance and hedge that downside risk because, again, this was a very anomalous event that came out of nowhere and a lot of people were caught off guard, and it caused some selling, perhaps some panic selling that perhaps hurt performance in the short term or so. So insure yourselves and look at buying insurance when it's cheap. Now, Eric, moving on to the US dollar, what are your thoughts here?
Louis Gav's call from last week's podcast that we might be entering a new U.S. dollar bear market seems supported so far by the tape action. We had a test of 102. That was the lowest print since March on the Dixie. We're bouncing nicely off that level, almost at 103 now. A new lower low, though, that would be a close below 102, would be a big tell. It's early to say that that's going to happen. The hot inflation print suggests that maybe those 5 rate cuts everybody was expecting this year might not happen after all. So there's room to argue in either direction here. Let's see what happens.
Well, Eric, it would be interesting to see whether the strong retail sales and other types of data points like this allow the U.S. dollar to recover a little bit, at least from a very oversold condition. But I really wanted to highlight on page 8 the U.S. dollar yen, because this really was where all of the action was. And we were quite oversold on the U.S. dollar on a relative basis. And so far, the bounce back in the U.S. dollar yen has been very benign. I think that there's plenty of room for this to even temporarily trade back towards 150 and test some areas. But the bigger question is is there another major move on the downside coming in the U.S. dollar yen in the second half of the year? And right now the bounce is underway. This is going to keep some short-term summer doldrums going. But will there be big action coming in the new year is the thing to watch.
Moving on to page 9, we have that gold futures chart. What are you guys thinking here?
The gold bull market rages on, but obviously the hot inflation print means rate cuts are less likely, and that's going to hurt gold in the short term. So yeah, I get it. We got slammed on Wednesday with more than a $40 intraday correction from peak to trough. That was on the hotter than expected inflation print, and frankly, it's no surprise and no real reason for concern as far as I'm concerned. Longer term, remember, structural inflation, which for years now I've been convinced is what's really going on here, is super bullish for gold. Eventually, the Fed won't be able to hike rates enough to fight structural inflation because doing so would bankrupt the U.S. government. When that happens, real rates will utterly collapse and gold will soar. Now, that's not happening quite yet, but already we're in a bull market. All of the moving averages are pointed up, and I'm not at all concerned about this inflation print. It's noise. Maybe we've got some more downside to go. We just had a really nice brisk swing back up to retest the all-time highs. Maybe that was a swing high, and we got a swing back low again. I'm not too worried about it. This is a bull market. Let's give it room to breathe and not be discouraged if more hot inflation data in coming days and weeks adds a few more stumbling blocks for this bull market to overcome.
Eric, when looking at this chart, the pattern is very clear. It's in a bull trend above its moving averages. The pattern of higher highs and higher lows is persistent, and this at this point continues to look like it has the potential for a bull breakout.
Moving on to page 10, we have that uranium chart. Eric, what are your thoughts here?
Well, the market is likely bottoming here, but I've said that before a couple of times in this podcast, and it actually had lower to go. Might still be the case that we still have lower to go, but at the end of the day, what matters is we need to see trading volume pick up on the very thin, quiet summer uranium spot market, which sees almost no volume in the dog days of summer. Until that volume comes back into the market, we shouldn't expect higher prices on the mining shares. Spot uranium has not sold off below $80 despite the almost nil trading volume. And that means that when the buyers do return, there could be a brisk move to the upside. SPUT, that's the Sprott Physical Uranium Trust, is holding its own even as the miners continue to sell off. And more so, SPUT trading below 15% discount to its NAV. That's you can buy spot and effectively buy physical uranium for 15% off of the already low $81 spot price, or $81.50, I think it was today. That's an amazingly good deal. In the past, anytime we saw a 15% discount to NAV on spot simultaneously occurring with a sub-30 RSI, that's historically marked market bottoms within a few percent. But markets love to make fools of as many people as possible. So who knows, maybe there's another spot market head fake below 80 that could panic everyone and freak out even more retail investors, causing them to abandon their positions in the uranium mining shares. Yeah, if that happens, it's just an even better opportunity to buy, and I'll certainly be buying it. The World Nuclear Association conference in London, September 4th through 6th this year, has in the past been a really big bullish or seasonal catalyst, kind of kicking off the fall contracting season. So we may have to wait for September before we see higher numbers in this market. Meanwhile, I look forward to meeting some of you at the World Nuclear Association event in London.
Yeah, Eric, it just has not gotten any love yet. At some point, there's going to be a turn in the charts and flows are going to start to show that a new bull cycle has begun. But right now, there really isn't a pulse to be found. It'll be interesting to see what will be the ultimate catalyst to restart things up in the uranium space, but it's certainly not here yet. Finally, I just wanted to touch on the U.S. 10-year Treasury yield on page 11. What we really saw was a massive drop in yields during that whole event. And now with a retest and strong economic data in the U.S., it might be a scenario where we crawl back above 4% here on a short-term basis and even maybe see levels as high as 4.10, retracing back toward those moving averages. In general, I think that bonds will continue to be a safe haven during these periods, but with such an extraordinary move in yields over the summer, them mean reverting back into the midpoints of where they were trading is not out of line.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.